So in this video, I'm going to show you how to write off 100% of a vehicle. We have new rules that just passed, and I'm going to walk you through step by step how to do this as a practicing accountant and tax strategist at keepmost.com, where we help people keep most of their money. Let's get into it. So start with the basics, right? You may now deduct 100% of a qualifying vehicle in 2025, right? So the new law places this in service by January 19, 2025. So what does that mean? That means that it's retroactive. So you can take bonus depreciation as long as you have a vehicle that was placed in service by January 19th of 2025, right? And once again, you can get up to 100% of that write-off in the first year. Now, this works for both new and used vehicles. And as you know, this can save you thousands of dollars in taxes, right? My clients love this strategy here. But here's the thing. There are 5 rules that you must know and that you must keep in mind. All right, so what are the 5 rules that you must know? Well, the first one is that you must have a trade or a business, where you can only take and write off a vehicle if it's used for business purposes. The next thing is that the vehicle must weigh 6,000 pounds or more. That is the key here, okay? There are many rules, but that is one of the biggest, all right? It must weigh over 6,000 pounds to take 100% or up to 100% of that write-off. We'll talk more about that in a second. Third, the business use must exceed 50%, which means you must use that vehicle for your business at least 50% of the time. Number 4, you must choose the actual expense method to use bonus depreciation. And number 5 is that you must plan for depreciation recapture. Most people don't, right? But you will. So let's start off with just defining what bonus depreciation actually is. Bonus depreciation is writing off the full cost now. You see, normal depreciation is spread over years, but with bonus depreciation, you could take up to 100% in the year placed in service, right? So that being the first year that you placed in service. And what a lot of people actually do is they wait until the end of the year, right? Some people wait till the last day of the year to place the vehicle, to buy that vehicle and place it in service. All right. And this applies to vehicles if they meet the IRS rules, which we will talk about here shortly. So let's go over rule number 1. You must have a trade or a business. Only business owners and self-employed people qualify. So business owners, freelancers, contractors, side gig workers, right? They qualify. Uber, Lyft drivers, equal self-employed, they qualify. W-2 employees cannot claim this deduction. Now, you don't need an LLC, right? You don't need an operating agreement. You don't need an S corp. You just need a business that makes income, right? However your entity is structured. Now, rule number 2 is that your vehicle gross vehicle weight rating must be 6,000 pounds or more. All right. Once again, that's key. Gross vehicle weight rating. Let's get into it. So only vehicles over 6,000 pounds may qualify for the full deduction. Below 6,000 pounds is classified as a passenger auto, which has a around $20,000 cap. But above 6,000 pounds, right, you could take up to 100% bonus depreciation. You're eligible to do so. Now, that's large SUVs, trucks, and vans qualify for this. Now, what are some popular vehicles, right, that are over this gross vehicle weight rating? You see these a lot amongst entrepreneurs because they get that deduction. So the Land Rover Defender, all right, a little typo there. Land Rover Defender is a popular one. In fact, my wife, she owns a large luxury candle company, all right? And when she wanted a new vehicle, guess which one we chose? One over 6,000 pounds. That being the Land Rover Defender. She loves it. Next, the G-Wagon. We see those all the time, right? Amongst business owners. Tesla Model X used to have that. Ford Expedition and Range Rover, right? These are some of the most popular vehicles over 6,000 pounds, but there are many vehicles to choose from. You just need to make sure that it meets that qualification. All right, let's go over rule number 3, and that is that business use must exceed 50%. All right, so what does this actually mean? Well, let's define business use. That's you traveling between job sites, right? You shipping things off, like going to UPS, or client meetings. Personal trips do not count. Now, less than 50% use, no bonus depreciation, right? And we'll talk about that. Now, bonus depreciation only applies to the business use percentage of the cost. What does that mean? Well, that means that if you only use your vehicle for 60% of the time, then you write off 100% of 60% of the cost of the vehicle. Hopefully that makes sense. So let's go into the deduction method, right? How do you actually take this deduction and this write-off? Well, that's when we get into rule number 4, which is you must choose the actual expense method. There are 2 methods that actually exist. Only one of them unlocks bonus depreciation. You have the mileage method, right, which gets you a flat 70 cents per mile in 2025. Then you have the actual method, right, where you get to write off your gas, your repairs, insurance, registration, tires, tolls, and depreciation, right? Now, to be honest, it might actually work out that the mileage method might still outpace the actual method, but that's not the case for most people, right? But like we said, if you want to take bonus depreciation and get 100% write-off, you have to use the actual method. And the method choice is permanent if depreciation is claimed. So once you do this, you can't go back and say, okay, I'm gonna use it this year, and then next year I'm gonna use the mileage method. Once you take depreciation, once it's claimed, you are not able to switch methods. Let's go into rule number 5. You must plan for depreciation recapture. So what is that? Well, selling or underusing the vehicle may trigger taxable income. So once fully depreciated, your basis is $0. If you sell it later for $50K, you must report $50K as taxable ordinary income. That's the recapture part of it. If business use drops below 50%, the IRS may claw back depreciation. Okay? So let's go over the 5 rules again. You must have a business or be self-employed with income. Your vehicle must weigh over 6,000 pounds. That's gross vehicle weight rating. 50% of the use is business or more. And you elect actual expense method. And you plan ahead for depreciation recapture. So let's see how this works in real life with real numbers. Say we have a $70,000 SUV versus a $70,000 sedan. Let's look at the tax savings. Same price, different deductions. That SUV is over 6,000 pounds with 100% business use, and that gets you a $70K deduction, which is around $26,000 in tax savings, right? If you're at the 37% tax bracket. Now, you have an SUV that's also 6,000 pounds, but you only use it 50% for business use. Well, you get half the deduction, right? So around 35K, okay? And that gets you around an $18,000 tax savings. Next, you have a sedan. It's a less than 6,000 pounds. Well, you're capped at around a $20,000 deduction, which gives you around a $7,000 tax savings. So as you can see, to take the 100%, it needs to be over 6,000 pounds, and you actually have to use it 100% for business. But if you don't, then you just take that difference there as far as the percentage goes. Now, a lot of people have this question. What if you finance? What if you paying cash, leasing, buying? Let's talk about it. Let's look at a financing example, right? With deducting full price, even with $10,000 down, because deduction is based on full purchase price and not cash paid. Let's say you buy a qualified SUV for $70,000. You put $10K down, which means you finance $60,000 of it. Your year 1 deduction is $70,000, not just $10K. So no matter how much you put down, you take it off the cost of the vehicle. And that's why most people love this strategy, because you could put down a little bit of money and get a big deduction up front, right? You keep most of your money. Now, can you take bonus depreciation if you lease the vehicle? Well, bonus depreciation applies only if you own the vehicle. So if you lease it, you deduct business percentage of the lease payments, right? But you cannot take bonus depreciation. It's only available if you buy, which is cash or finance the car. Now, the exception here is if you buy out the lease early or at the end of the lease, then you are eligible to take the bonus depreciation. So how do you actually implement this? How do we put it all together? Well, let's walk through it step by step. Steps number 1 and 2 is that you confirm business use and you choose the vehicle. So verify business self-employment income, right? Check the gross vehicle weight rating label on the vehicle, right? Not just the regular weight. And record purchase contract for your tax files, just in case. Now, steps 3 through 5 is that you track the use, you choose the method, and you apply depreciation. So you want to keep proof, elect actual expense method, and then file correctly. So track your mileage to prove greater than 50% business use. Select the actual expense method when filing, and apply 100% bonus depreciation in the year of purchase and the year you place it in service. So how do you actually track the mileage and expenses? Well, documentation is your best protection here. You want to install a mileage tracking app, right? Like MileIQ or TripLog. Those are 2 popular mileage tracking apps. Next, you want to categorize each trip as business or personal use. That way you can see and weigh how much your business use percentage actually is. Keep receipts for things like your gas, repairs, insurance. And if you're audited and you have no log, then the IRS will deny your entire deduction. But that's not you because you have these things here, right? And that's it. That is the entire thing. Really simple, really easy, but you just have to follow a few steps. Now, if you like this video, go ahead and like the video and also subscribe to the channel. And once again, my name is Karan and I'll see you in the next video.